Good morning. I would like to talk to all the sensible people out there that understand a little bit about economics. Unfortunately, our culture today has become accustomed to easy credit. And even after the advent of the housing boom and debacle and the financial street debacle, we're still operating under the easy money scenario. And as a result, we're doing risky behaviors that aren't helping our future. What I mean by easy money is that during the housing boom, a lot of the poor were blamed for the debacle, when in actuality, the easy money was provided by basically bringing all of the mortgages together in a financial package done by Wall Street, and then sold as AAA bonds and securities, so AAA and high security, and I'm not speaking very technical right now, and not very accurately because I haven't looked up the exact definition, but basically get my drift. What we've been doing for the past 30 or 40 years has been basically borrowing money so that we could finance our future. In housing was the most obvious one. The problem with the easy money was that at very low interest rates is that individuals could qualify for more borrowing. What I mean to say is that when you have an interest rate on a loan of 10% and you make $30,000 a year, then let's say, for instance, that you can qualify for, say, a $100,000 home. If the interest rate drops to 5%, it means that you can actually borrow $150,000. Now, that's not the true numbers. Actually, you'd have to, if you wanted to, okay, I'm going to do all the financial, and it'll be noted here in type and stuff. For you, what you can qualify for. So when 5% drops down, then you can qualify for more loan, a bigger loan that you can service, more debt that you can service. When you apply it to housing, what happens is the scarcity of money drives the prices down, meaning that there's less buyers that can afford a $150,000 home. When the interest rate drops, then it frees up borrowing power so people can borrow more money. And as a result, the market will raise to whatever you can borrow. Say, for instance, a $100,000 home at 5% or 10%. If the interest rate drops, then now the borrowers can borrow more money. That frees up the market to go up. So a $100,000 home starts appreciating 110, 115, 120. You end up buying the same house, but for more debt at 5%. And now it's even lower down to, practically, 2 and 3%. The problem with that is this, is you got to more debt just to buy the same house. And then eventually, it gets to such a ridiculous phase that people are not even concerned about debt until it finally crashes and people are upside down in their homes. I saw this coming a long time before the crash. I'd run into people and say, "So what do you do?" "Oh, I'm a mortgage banker." "What did you used to do?" "Oh, I used to be a teacher." "Well, then why are you a mortgage banker or a realtor?" It's because people act like lemmings. They hear them gold in them air hills, and they all rush off like lemmings, selling their farms, their factories, to rush off into the hills to get their lotto ticket. Well, history has shown time and time and time and time again that gold rushes don't make people rich. Wise investment and use of your assets and limited borrowing. Only borrowing with wisdom. You have to use money in a wise way in order to become affluent. I am really disappointed in this gold rush mentality, but it happens all the time. It happens for the MBAs. Everybody rushes, oh, you got to get an MBA, and so everybody rushes off for an MBA. Back about 20, 30 years ago. Then everybody's doing day trading. Oh, let's do day trading. That's gold rush, gold rush. Oh, so everybody rushes into a particular position, and then there's a scarcity of that particular product. Come on, wise up. I'm just too disappointed to talk any further.